Greetings, everyone. This is Kathy Wood from ARK Invest. It has certainly been an exciting, I guess you might say it that way, 4 months. We've seen almost a full market cycle in almost 4 months when it comes to certain strategies. So what I'd like to do this month is, well, what I always do. We'll talk about the macros. I think the backdrop is very important, and we do have a point of view. So we'll start with a policy backdrop. Then we'll talk about economic indicators. Then we'll talk about market signals, market indicators, and what we believe the outlook is for the economy and the markets. Okay, so on the fiscal policy front, well, the stimulus, the first part of it is in place. We're seeing it come through the economic statistics as well. And it does look like we're going to get somewhat of an infrastructure bill, which may include tax increases, but I think the odds there are going down. The closer we get to the midterm elections, given how razor thin the margins are in both the House of Representatives and the Senate, the lower the likelihood of significant tax measures. Nonetheless, we did get the proposal, the tax proposal. It includes an increase in the capital gains tax rate, the top rate, the very top rate, going to 43.4%. And I believe right now that's 22.8%. So quite a big jump. And because of that proposal, I think we've seen a lot of the high-flying stocks, the ones with very significant gains during the past year and a half, those, I believe, were hit hard because of that proposal. Rarely is the capital gains tax rate put in place, or a change put in place retroactively. So I do think investors jumped the gun on that one, understandably. I doubt we're going to see anything near that rate. And in fact, I am wondering if we're going to see much in the way of tax increases, as I just mentioned. We know that the corporate tax rate will probably not go from 21 to 28%. Perhaps it will go to 25%. That seems to be the compromise brewing. And the top tax rate for high income earners going back to 41.8%, perhaps that goes through. The capital gains tax rate, I'm very doubtful. Now, on monetary policy, the M2 growth rate on a year-over-year basis is 24.2. I think it peaked out at 27%, so the deceleration has begun, but that is still a very rapid rate by historical standards. And because of it, and because the Fed is saying it will continue to err on the side of ease until inflation is above 2% for a sustained period of time. So again, the markets are not expecting much in the way of Fed tightening before late 2022 or early 2023. Now, we could be surprised. There are some inflation gauges that are picking up some steam. But so far, so good. The bond market is not following through on the big sell-off it had in the first quarter, and we'll talk a bit about that in a moment. The Fed does continue to talk about the base effect, so the impact of the collapse in commodity prices last year, commodity and other prices last year during the depths of the coronavirus, and the comparisons we're facing now. So oil dropped, I believe, below $30 for a moment in time back then. And now it is over $60, so more than a doubling in a very important price. And it does seem, according to the University of Michigan, that inflation expectations have picked up a bit. when looking at a 1 year time frame, but looking at a 5 to 10 year time frame, inflation expectations are still in the 2.5, maybe a little north of that percent range. I have been surprised that some of the commodity prices are spiking and breaking out of very, very, very long-term bases. And I'll go into that in a moment. It certainly has my attention. And I know anyone who's been building a house or renovating knows that lumber prices have tripled, I think, in the last 6 to 9 months, quite dramatically. On the economic indicator front, now we still believe we're in a V-shaped recovery, and that there will be nothing getting in the way in the short term. In fact, businesses continue to scramble. They cannot keep up with what's going on out there. Now, you wouldn't know that from the employment report we just got today. The employment report was quite weak relative to expectations. So an increase of 266,000 in non-farm employment. The expectation was close to 1 million, an increase of 1 million. And if you take the downward revisions, the net employment increase was closer to only 188,000. So what is going on if businesses are scrambling and can't meet demand? What is going on is if you pay people not to work, they won't work. And I think a lot of companies are having trouble finding help. And in fact, one of the important clues of that is, and I've never seen anything like this, is temporary employment dropped 111,000 in 1 month. What does that tell us? It tells us, though, that those companies who have hired temps and realize they cannot find employees on a permanent basis, they are luring the temporary employment, the people who are working for them temporarily, they're luring them in probably with some pretty good packages. And what we saw in average hourly earnings would confirm that. Leisure and hospitality is picking up dramatically now. I think the number was close to 350,000 increase in that employment level. Those wages, the wages for that category of employment, are much lower than average. So the mix shift should be pushing down average hourly earnings. Maybe not putting them into negative territory, but flat to up 1 or 0.2% per month. Instead, we got an increase of 0.8%. So the costs are going up to attract labor. We think that's temporary, that when this stimulus package runs out, that will correct. But for right now, that is feeding fears of inflation. On the other hand, what we have is productivity gains, and they are quite large. On a year-over-year basis, I think this last quarter we're up 4.1%, and on a sequential basis, annualized, 5.4%. So strong and getting stronger. Unit labor costs are up 1.6% on a year-over-year basis. So that's consistent with a very low level of inflation and a high level of compensation in the short term. Productivity, if productivity gains accompany output increases, then the benefits should accrue, in part at least, to workers in the form of higher compensation. We got some consumption numbers in the last month that were stunning. The retail sales report, the expectation was that retail sales would increase 5.8% in March as the stimulus checks were going out. Instead, the number was 9.8%. Now, that's not a year-over-year increase. That is a month-to-month. So think about that. If you annualize almost 10%, that's more than 100% growth. So stunning, stunning consumption gains. At the same time, industrial production is lagging expectations. Industrial production in March was up only 1.4%. The expectations were that it would be up 2.5%. That did not happen. Again, part of the reason is labor shortages, and again, businesses are scrambling. One of the things we worry about in an environment like this is that there's going to be double and triple ordering, that if companies cannot get supplies, they will over order, and they're willing to build inventories as they're facing these shortages. The problem with that is that we most surely will have a significant inventory build. I don't think it's going to be this year, but into next year, a significant inventory build, which could cause quite a serious correction in commodity prices. The question is, how much higher do they go now? When will lumber demand fall off? We're up threefold now. Surely some people are revisiting plans to renovate or delaying plans to build. We'll see how long that takes. We are facing a very interesting issue. So businesses scrambling, productivity increasing, pricing power increasing. What this is telling us is profits are screaming. And last year, I remember talking about a V-shaped recovery where by the end of 2021, perhaps we would see an annualized rate of S&P earnings at the $200 range. It looks like we've passed it already, and that we could be at 250, 260 moving into 2022. And with the S&P at roughly 4,200, that means we're looking at a multiple of 16 to 17 times, which given interest rates in the 1.5% range, which is where we are in the 10-year Treasury yield, that is a very modest multiple. So now onto the market. I know that late last year and into early this year, we had been saying that we believed the market would rotate and start to reward more sectors, more value sectors that had been neglected. That it has done, most assuredly. In fact, perhaps more so than I might have expected. And at the time we said, look, innovation-based strategies will underperform during that kind of market. And of course, that too has happened. We're fascinated to see that the two top performers this year are energy, up 40% year to date, if you can believe that, and financials up 27% year to date. And if you look at innovation type strategies, the kind of hit they've taken here, from the peak in the middle of February, many are down 30 to 35%, which is quite a hit. Now, as I said earlier, I think exacerbating that hit has been the threat of a near doubling in the capital gains tax rate. So innovation-oriented strategies would be hit hardest by that. I also mentioned in the last call, I believe, that we have been very reassured that the equity markets have gotten through three mini crises in the last 4 months. One was in the first quarter interest rates, long-term treasury yields, nearly doubled from 90 to 175 basis points. That is the equivalent of a heart attack in the bond market. And normally the bond market impacts the stock market. Whenever there's anything very sudden happening in a very important economic gauge out there, the equity markets responded. Well, the equity markets took the yield increase as a sign that the cycle was beginning to grab hold and gain even more momentum. And that is true. It has done that. As I explained last time, however, we were struck that that a capital ratio, which the Fed, a bank capital ratio, which during the depths of the coronavirus, the Fed made more lenient, enabling banks to buy long-term bonds instead of just bills to satisfy the capital ratios. That ended at the end of March, and interest rates having shot up that quickly, many people thinking because of the cycle, most assumed that they would continue to move up. Well, they have not. And it is very interesting. Again, the highly valued stocks, those associated with innovation, the interest rate move did hit them hard, or finally it hit them hard during the first month and a half of this year. They seemed impervious to almost anything. Well, now interest rates have settled down against expectations. I think even today the consensus expectation is long-term interest rates will continue to move up, and they may. But it is interesting that the ending of that leniency on the part of the Fed vis-a-vis the capital ratios coincided with interest rates topping out. I think most portfolio managers, analysts, strategists would be very surprised if interest rates were topping out now. Cyclically. And I can't even tell you if they are. I'm just struck that we've had a lot of these booming indicators, commodity prices. You've got copper prices breaking out of, let's see, I think this is a 15 to 20 year base that went from, I think it was from 200 to 465. That's the copper price. It has now moved out to 475. And most traders would tell you when any price has spent 15 to 20 years in a base and then resolves to one side, it's usually the beginning of a very big move. Now, it could be. We're watching this very, very carefully, but it is curious in the face of that long-term treasury yields have moved back down. And at the same time, the dollar has come down, which is feeding commodity prices. And yet, once again, the long-term treasury bond is not responding to it. So I find that very interesting. Now, this reminds me of a confusing period in certainly my investment life. I remember in 2006, it was toward the end of 2006, moving into 2007, that we saw commodity prices booming. So oil went from $60, which is roughly where it is now, by the way, from $60 near the end of 06 to $140 throughout 07 into 08. And we were in the housing crisis. And I remember back then pulling a lot of risk out of the portfolio at the time. And in doing so, we left a lot of money on the table because the stock market was embracing very strong recovery. And at the same time, bond yields were coming down. And I was, again, very, very confused by all of this. I didn't know what to make of it. And it was a very painful period. Again, I have a macro background. I have a point of view usually. And there were just so many conflicting signals. Those were just two. We could be in another such period. Now, back then, what was happening was the bond market was looking at what was going on in the housing market and how regulators were not too happy at all of the exotic home equity loans, so much so that 5 regulators penned a press release and said just as much as that. And I know these regulators, who are usually fighting for turf, rarely get together. So I thought they would do something quite significant. And they did. They did start cracking down, and that was the beginning of the end of the housing bubble. Now, I don't think housing is the issue this time at all. And we don't see the crazy practices around exotic home equity loans, 0% down, nothing like that, partly because of the crisis and the regulatory aftermath. Instead, I think the confusion has to do with the bond market looking at now 3 sources of deflation on the horizon. Now, you've heard me talk about 2 of them. There's the good deflation associated with innovation, which spurs dramatic growth. So really good. And to give you a sense of the drama in terms of the deflationary undercurrents, undertows, that innovation is starting to pull on the economy, we use one of the most dramatic in DNA sequencing. Now, healthcare is almost 20% of GDP, and it's never seen deflation except for patent cliffs, and that's a very bad source of deflation. Healthcare, I don't think, has ever seen good deflation until now. So DNA sequencing costs for every cumulative doubling in the number of whole human genome sequenced. And we're in very, very early days now. So we're going to see a lot of cumulative doublings. For every cumulative doubling, costs decline 40%. This is a bit of a shock to analysts who have watched healthcare and know nothing but inflation and actually base their models on inflation. In the battery space, battery pack systems for every cumulative doubling, and we're in very early days of electric vehicles, so we're going to see many cumulative doublings. Those costs drop 28%. So think about that. In the transportation sector, deflation driving a boom in electric vehicles. We're seeing the same in industrial robots. I think it's roughly 25% there. We're seeing artificial intelligence training costs drop anywhere from 37% to 50% per year. So, and artificial intelligence is going to permeate every sector, every industry, every company. And those companies not embracing it the way they should are going to lose out competitively. So we're very excited about that source of deflation because it will cause a boom. So that's a deflationary boom. We think that the ramifications of this good deflation are going to include creative destruction. The disintermediation or disruption of the traditional world order. And we think that roughly 50% of the S&P 500 is at risk of creative destruction. Some more, some less, but 50%. And what does this mean? What we think is going to happen here for those companies who spent the last 20 years catering to short-term investors who wanted their profits and wanted them now, Companies were leveraging up to buy back shares, pay dividends, and they were not investing enough in innovation. In fact, many didn't take seriously the idea that innovation was a threat. I know when we started ARC in 2014, auto manufacturers, auto analysts thought, this was something for the mid-20s, maybe. And we were looking at the cost declines in battery pack systems, and we were saying, nope, this is happening now. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life. So we're going to see a lot of that in financial services, energy. So the two sectors that have done best this year, we believe, are two of the most vulnerable sectors. In the energy space, again, up 40% year to date. We think that electric vehicles, and especially autonomous electric vehicles as they launch within the next few years, are going to put a big dent in oil demand. And within financial services, we see digital wallets evolving so much faster than I think anyone could have dreamed. China showed us the way through WeChat Pay and Alipay, and now Square's Cash App and Venmo are moving so quickly that their user base has scaled well beyond JP Morgan's customer base in just a few years, in the last 5 years, whereas JP Morgan got to this level one acquisition at the time. The digital wallet evolution or revolution has gone viral, and there's a social networking element to it. So very interesting space. And so financial services buyers beware. So that's the bad deflation. Those companies that are too leveraged and have products that will be obsolete are going to have to sell those products at a discount increasingly in order to service their debt. So good deflation on one side associated with an innovation, and bad deflation associated with the creative destruction caused by innovation. The third source of deflation that we believe will take place maybe toward the end of this year, probably more likely next year, is commodity deflation. We believe that there is a lot of double and triple ordering taking place right now, and companies never quite know if it is double or triple ordering. I think supply chain management systems are getting better, so maybe it won't be as bad as it has been historically. But we do think that inventories will build to a level well above demand sometime next year, and that the unwinding of them will cause an unwinding of commodity prices. That said, we want to keep an open mind here. When I see a breakout from a 20-year base, as we've just seen in copper, I pay attention. Now, on oil, we have not. And in fact, $140 was the peak in 2008, and every peak since then has been at a lower level. So right now we're at 60, and I believe the last peak we saw was in the either high 70s, low 80s. So I'd be very surprised if we go above that level. If we do, then we will, score another one for the inflation risks are picking up. The other thing we're watching is the dollar. To see the dollar break down would be somewhat concerning. Now, the dollar is priced against other currencies. So part of that is a function, perhaps, of our monetary policies relative to those elsewhere in the world. And just on that note, I will say the country that has handled this crisis the best in terms of not throwing money at it willy-nilly is China. And I think that will accrue to their benefit in the years ahead. So I would say watch that space as well. So with that, I just wanted to call out some of our thoughts. We do believe deflation is the bigger risk. The reason I like being on that side of the bet is that it seems like everyone is on the other side. And usually, if that is true, then if we're wrong, then inflation has been or is being discounted in the market right now. So we'll be perhaps uniquely wrong, and it's good to be uniquely wrong. If everybody else expects one thing, then it's probably getting priced into the market. But I think these three sources of deflation are going to throw economists off. As I said, I remember feeling very confused in the '06 period. Interest rates were doing this while were going down, while commodity prices were going up. And so it's at these times that if you do take a stand, differentiated from the crowd, for good reason, not just to be contrarian, the payoff can be enormous. And in terms of the recent behavior of value stocks, especially those that we believe are in harm's way, compared to the severe drawdown of innovation-oriented stocks, I like that setup very, very much. And just to finish on that note, we have a 5-year time horizon, as do most focused on long-term innovation. And in the middle of February, those strategies generally, according to our analysis, suggested that innovation would reward investors, again, if the analysis, top-down, bottom-up, of the possibilities associated with innovation are correct, would deliver a 15% compound annual rate of return over the next 5 years. Well, nothing has changed. Nothing has changed except the stock prices have come down. We're in bargain basement territory if our view on innovation is correct, the 5 innovation platforms. So if the return expected at the beginning of all of this was 15%, then the return expected now, again broadly, should be in the 25 to 30% range per year on average during the next 5 years. I love the setup, and we do think the bull market has broadened out, and we're looking forward to innovation joining the party once again. So thank you so much, and have a wonderful month. We'll be back to you if anything completely unexpected happens, but in the meantime, have a lovely spring.